Since the middle of February, the stock market has seen one of its fastest corrections of all time, only taking 16 trading days to reach correction territory, which is a decline of greater than 10%. And as of right now, the S&P 500 is down about 10%, while the Nasdaq is down about 15% since its recent highs, meaning the Nasdaq is officially in correction territory and also getting near a bear market. So today, I'm going to be looking at three stocks that I also have bought in the past week and I think is a great buy today, and I'll be analyzing these stocks and showing you guys what I think the intrinsic value of these stocks are. And these stocks I think are one of the best buys as of right now, and I am looking to buy even more as the market tanks. The first stock that I'm going to be looking at to buy in this market crash, in which I have also bought more over the past week, is Alphabet, or Google. Google is an American multinational corporation and technology company focusing on online advertising, search engine technology, cloud computing, and computer software. Google makes the largest amount of money compared to any US company. They have a net income of over $100 billion, and Google stock is down over 25% just since its recent high in February. So I think this is a very good opportunity to look at Google stock and see if we should buy the company using my 7-step stock analysis. If we go ahead and look at my 7-step stock analysis, the first thing I want to see for Google is the PE ratio greater than 0. This is the price of the stock divided by the earnings per share. So as long as the earnings per share is positive, that means that the PE ratio will also be positive, which we want. And we want them to be making money. And as we can see here, Google has a PE ratio of 19.41, which is also a pretty low PE ratio for such a great company. So this shows that Google could be potentially undervalued with that low of a PE ratio. Now I'm going to look at the forward PE ratio, and I want this to be less than 30. This is also the same thing as the PE ratio. However, instead of the earnings per share as of today, it's the analyst expectations of earnings in the next 12 months. So we want this to be less than 30, showing that in the future, we think the stock could be undervalued and trading at a decent valuation. And as we can see here, they have a forward PE ratio of 17.54, which is very low for this type of company. And I'm pretty sure it's at really close to its lowest Google has been for a very long time. And which is why I have been buying this stock over the past week. And now let's look at the revenue growth rate. This is the sales of the company, and we want this to be growing at a greater than 5% rate. And as we can see here, Google has an 18% revenue growth rate, which is very high and is almost 4 times what we want of only 5%. So this looks very good for Google. And now let's go to the EPS growth rate. Similar with the revenue growth rate, we want this to be greater than 5%, and as we can see here, Google has a 22% EPS growth rate, which is the earnings per share. So basically the net income that they generate. So this is also another good thing for Google. And now let's go ahead and look at the shares outstanding. We want the shares outstanding to be decreasing over time. If the shares outstanding of a company decreases over time, that means if you remain constant with the amount of shares you have, you will own a greater percentage of the company. So as we can see here, Google is on average decreasing their shares by about 2% each year. So they are buying back shares at a pretty good rate, and they have been increasing these buybacks as of late. So this is very good, and I like to see that. Now, the debt to equity ratio. I want this to be less than 50%. If the debt to equity is less than 50%, that means they will have greater than double the amount of equity compared to their debt. For example, if they had less than 50%, that means they would have more than double the amount of equity compared to their debt, which will show us that they likely won't go bankrupt and have a pretty good balance sheet. And as we can see here, they only have an 8.65% debt to equity ratio. This means they have about 12 times the amount of equity compared to their debt, which shows that it is very unlikely for Google to go bankrupt unless something terrible happens. And for the final metric I'm going to look at for Google is the expected EPS growth rate. This is the analyst expectations over the next 5 years, and we want this to be greater than 5%. Analysts expect Google to grow at about a 16% EPS rate over the next 5 years. So that is also another check mark and shows us that Google will probably grow at a pretty much the same rate as it has been over the past few years. So that's also another check mark. And as we can see, Google has all 7 check marks and shows that the financials and balance sheet looks pretty good for Google. Now with Google, I'm going to analyze the company and see what we should pay for the stock today to return about a 15% rate. We want to return about a 15% rate over time. Since the stock market averages about a 9% rate, we want to have a good margin of safety, and also the only reason we're going to buy individual stocks is to outperform the market. So for the first thing I have to do is input assumptions for Google. And for the revenue growth rate, I'm going to put this at 15%. Analysts expect about 15 to 16% rate over the next 5 years. Net profit margin, I'm actually going to leave this at 30%. While they have never been at 30%, last year they were at about a 29% rate, so I think they can get up to 30% and stay about there. For terminal P ratio, I'm also going to leave this at 20 because I think that's a very fair value for Google. And now for the discount rate, I'm going to put at 15%. Like I said at the beginning, we want a 15% return on our invested capital. And as we can see here, I have a fair value price for Google at about $252 per share. And if you bought today with these assumptions and you truly believe these assumptions, I think each year you can make about a 22% return on your money, which is why I have Google as my biggest position in my portfolio. While it is slightly worrying about the lawsuits and DOJ on Google, I still think that Google will still come out superior, and I think they'll just grow at a very consistent rate, and I think they're trading at a very attractive price right now, which is why I'm buying Google over the past few weeks, and if it keeps going down, I'm just going to keep buying more. The next company I'm going to look at is Arista Networks. Arista Networks is an American computer networking company that is known for designing and selling multi-layer network switches for data centers, cloud computing, and high-frequency trading environments. Arista Networks provides these services for huge companies such as Meta and Microsoft, to name a few. Arista Networks is down almost 35% since its recent high, so this is why I have been adding in my position of Arista Networks since it has been tanking so much. I've been adding over the past few weeks and just continuing to dollar cost average my price down because I think this company is a great solid company and growing at a very fast pace. If we go ahead and look at the 7-step stock analysis for Arista Networks, we're going to first look at the PE ratio. As we can see, we want this to be greater than 0, and Arista Networks has a PE ratio of 34.95. While it is a little bit high, I do think this company can deserve a greater PE ratio just because of the high growth rate of the company. Now, if we look at the forward PE ratio, we want less than 30. It is an X right here, 30.86, barely an X for Arista Networks. However, I think this could be a reasonable PE ratio for Arista Networks. So that is our first X for Arista Networks on my 7-step stock analysis. Now for the revenue growth rate, we want this greater than 5%, and as we can see here, Arista Networks has a 28% revenue growth rate, which is so much higher than what we want, and this shows great growth of the company. And now let's go to the EPS growth rate of greater than 5%, and as we can see, they're growing at a 42% rate, which is insanely fast growth for such a good company. And this, I think this is a great growth company to potentially add to your portfolio. Now let's look at the shares outstanding. We want this to be decreasing. However, Arista Networks is basically left their shares flat, so it's not the worst thing ever, but it's not the best thing ever. But at least they're not diluting us shareholders. Now the debt to equity ratio. We want this to be less than 50%, and as we can see, their debt to equity ratio is only 0.6%. This is one of my favorite parts of the company Arista Networks. They have about $9 billion in cash and only a few $100 million in debt. So they have almost no debt compared to even their cash. They can pay off their debt within a second. This is how low the debt this company has, which is why I really like this company. And finally, we want the expected EPS growth rate to be greater than 5%, and analysts expect Arista Networks to grow at about a 15% rate, so that is also another check mark. Now if we go ahead and use my intrinsic value calculator for Arista Networks, we're first going to have to put the revenue growth rate we think for Arista Networks. I think Arista Networks can grow at about a, let's say, 16% rate. I think they can grow at about 16%. So now let's go to the net profit margin. I think that they could have a net profit margin of 40% over the next 10 years. Over the past year, they were at 41%, and they have been increasing this profit margin pretty consistently. So I'm going to put that right there. Now for the terminal PE ratio, I'm going to put this at 25. Just because of the high revenue growth rate and profit margin. With the discount rate, we're going to leave this at 15%. And as we can see here, I have a fair value price for Arista Networks at $82.50. So if you believe these assumptions, I think you can make about a 15% year over year return on your capital if you invested today. The final company that we're going to look at is Fabrinet. Fabrinet is a very underrated company and nobody really talks about it since it's a pretty small company. However, I think this is one of the best companies to buy right now. Fabrinet provides manufacturing, packaging, process technology, and supply chain services to various markets. They also include optical communications, automotive, industrial laser, and medical products. Fabrinet is down about 26% since its recent highs, showing a pretty good sign to buy the stock. I have also been buying this stock as it has been going down, and my average price is around $200. So let's go ahead and look at Fabrinet's 7-step stock analysis. And if we first look at the PE ratio, which we obviously want greater than 0, meaning Fabrinet is profitable. And as we can see here, they have a 21.94 PE ratio, which I think is very reasonable. And now if we look at the forward PE ratio, we actually don't know the forward PE ratio because since Fabrinet's a pretty small company, there's actually no analyst covering the company. So we don't know what the future EPS will be by analysts. So that is non-applicable here. Now if we go to the revenue growth rate, we have a revenue growth rate of 16% for Fabrinet, which is greater than 5%. And now the EPS growth rate is also a 12%. So far pretty decent growth. While it's not rapid increasing, I think it's a pretty decent growth, especially for the PE ratio. Now the shares outstanding, we want this to be decreasing, and as we can see, Fabrinet has been slightly buying back shares. And also, let's look at the debt to equity ratio. We want this to be less than 50%. As of right now, Fabrinet has a 0.3% debt to equity ratio. Similar to Arista Networks, they have a lot of cash compared to their debt, which they could pay off within also literally no time. So this means that Fabrinet is pretty unlikely to go bankrupt. Now, the expected EPS growth rate, like I said, we do not have analyst expectations for this company since it's a pretty small company. So that is also non-applicable, but we do have 5 out of the 5 7-step stock analysis checkmark. Now for the final stock, Fabrinet, I'm going to use my intrinsic value calculator once again to see what we should pay for this company. So firstly, I'm going to put a revenue growth rate at about 12% since analysts expected about that. Net profit margin, we can see they have been increasing their net profit margin at a pretty consistent rate. And as of the past year and over the past 3 years, it's been at 10%. So I think it's going to stay relatively around there at 10%. So let's put that net profit margin at 10%. Now if we go to the terminal PE ratio, we can see it's been about 20 to 22. So I'm going to put this at about 20. So as we can see here, similar to Arista Networks, I think it's at about its fair value price if you want a return of 15%. So as we can see here, I think the discounted fair value price for the fair value price for Fabrinet should be about $206 if you want a return of 15% year over year. So this is why I've been buying these stocks as of late, and I think if they continue to go lower, I'm going to add even more. So thank you guys for watching this video. If you have any recommendations down below, please put them. Please subscribe to the channel. We're trying to get to 1,000 subscribers, and thank you for watching.